Well, good afternoon, ladies and gentlemen, and welcome to the Wednesday Lunchtime Drive Through on this Wednesday, June 29th, the last Wednesday of the first half of the year. I don't want to panic you too much, but do you realize we are now less than 6 months away from Christmas? We're closer to this Christmas than we are to last Christmas. And the days are starting to get shorter, right? Summer solstice is past us, and now the days, well, the sunlight days, sunlight hours anyway, the day is still 24 hours. But the sunlight is starting to get a little bit less every day. Of course, that doesn't really translate to the thermometer. It's still going to be really hot if you're in Oklahoma and other parts of the South. Some of you are not. Today's topic, first of all, I'm Damon King. I am the lead instructor for ChappelWood University, the sponsor of the Wednesday Lunchtime Drive Through. I'm a certified financial planner, and I work with ChappelWood Financial Services. And I'm very happy to have many of our clients on the call today, as well as our longtime radio show listeners and other followers of the Wednesday Drive Through, as well as other things that we do. I've been getting a lot of questions lately about the market, of course, but probably the second most popular question I've been getting is, what are these I bonds that I keep hearing about? Susie Orman is talking about them, and every talking head on television is talking about I bonds. I've never heard of I bonds. What are these? So I thought today would be a great time to talk about what they are, and more importantly, how you can get them, because there is a specific process that you must go through in order to acquire these I bonds. And I'm going to share that process with you step by step today. And I will post this recording on our YouTube channel, and I'll send the link out to all of you who are registered for the drive-through so that you can watch this again and go through the process. So let's get into this. So first of all, what are I bonds? And I always have to stop. I get ahead of myself. If you have any questions about anything, whether it's the I bonds or just anything in general about life, about money, anything you want to ask, in this 30 minutes, that's what this class is for. So what are I bonds? I bonds are a U.S. government issued security that earns interest, and it's a two-part interest formula. There is a fixed rate plus an inflation adjusted rate. They add those two things together, and that gives you the total interest. Now, the fixed rate is fixed. Now, interestingly enough, the fixed rate right now on these I bonds is 0%. So right now, the interest is all the inflation adjusted rate. And it is important to know there is a reason adjusted. This rate does get adjusted periodically. We'll talk about that more in a second. Well, we'll talk about it now. I don't even remember my own bullet points. The inflation rate is adjusted every 6 months based on the rate of inflation at that time. So what is the purpose of an I bond? The purpose of an I bond, and the reason people are going after them right now, is because they are, by their nature, set to beat out the current rate of inflation. Not by much, but they are set so that the interest that they earn is beating the pace of inflation. Now, right now, I bonds that are issued between the months of May and October of 2022 are paying 9.62%. If you're going to buy other bonds like corporate bonds, things like that, about the only way you can get that kind of interest rate is to go out and buy what we call high yield bonds. They tend to be a little more risky than regular investment grade corporate bonds. But again, these are issued by the federal government of the United States, considered one of the safest investments in the world. So these are government-backed bonds, very safe and fairly liquid. I mean, there's a pretty big market for trading government-issued securities. And they are paying 9.62% right now, and that rate is locked in for 6 months from the date you buy it. So here's the situation. The bonds that are issued between May and October of this year are paying 9.62%. However, what if you decide to go out and you wait until September of this year to buy your I bonds? And think of I for inflation. If you wait until September, but the rates are good from May through October. Well, that's just the time period that if you buy any new bonds in that time period, you are going to receive 9.62%. However, wherever you purchase your bonds within that window, you are guaranteed to get that interest rate for at least 6 months. So if you purchase your I bonds in September, which is just 1 month before this window closes, your actual interest period is going to be 6 months. So that's that's October, November, December, January, February, March. Well, February. So it's September, October, November, December, January, February. So you are locked into that interest rate from September through February. Now, what happens later on when February rolls around? Well, they will reset the interest rate depending on whatever the rate of inflation is at that time. So in many ways, this is an adjustable rate bond. You're not going to get the same interest rate all the time. All right. And the bonds earn interest until it matures in 30 years. So this is a 30-year maturity date, or until you choose to cash it in, because you don't have to hold on to it for the whole 30 years. So whichever one of those comes first, you will earn interest, and it gets adjusted every 6 months based upon inflation. And until you cash it in, you will get that interest. So how do we go about buying I bonds? Well, right now, the best and probably the easiest way, and really the only way to purchase I bonds is through Treasury Direct. And actually, I misspelled Treasury. There is no E in Treasury at the end, so I have fat fingers. You're going to have to excuse me for that. But it's Treasury without an E, so S-U-R-Y. You want to go to treasurydirect.gov. This is a federal government website where you can actually set up an account so that you can purchase I bonds online. In fact, it's the only way that you can purchase I bonds, or the most amount at any one time. And I'm going to get into that in a second. All right. So go to treasurydirect.gov. And what you're going to see over here, if you look over on the right-hand side, you're going to see that green open an account link. You're going to click that link right there. All right. That's how you're going to open an account. However, before you just go purchasing anything, before you invest your money in anything, it's a good idea to understand what you are investing in. I gave you like a little 3-minute crash course on what I bonds are. My recommendation to you as a financial advisor, as an investment advisor, is educate yourself more than just 3 minutes before you put your money in something. So the first thing is learn a little bit first. And when you go to Treasury Direct, because I bonds are so popular right now, this is literally on their homepage right now. This is a screenshot that I took literally today. And you can see you can purchase I bonds at the current rate through October 2022. And there's a little button down there. It says learn more. You click that, and it's going to take you to this page right here. And you're going to see a lot of the key facts, things you need to know about I bonds. What are they? How is the interest rate set? Who can own one? How do I buy them? That sort of thing. So educate yourself before you invest in anything. Just because it's paying 9.62% and it's pretty safe doesn't mean you should just get into it. You wouldn't do that with any other investment, right? You shouldn't do that with this investment either. So there is my fiduciary disclaimer to you. But once you've satisfied yourself and you understand what these I bonds are, step one, you're going to want to make sure that when you click open an account on the homepage of treasurydirect.gov, you want to make sure that you've got some basic information on hand ahead of time. You're going to need your social security number, or they'll call it your tax ID number, or your taxpayer ID number. That's your social security number. You're going to need your current address. You're going to want the bank account number and your email address. Why do they need your bank account number? Because they're going to direct deposit the interest that you earn straight to your bank account. So if you want that to go to a checking or a savings account or a money market account, whatever, just give them the routing number and account number where you want those interest payments to go. When you first go there, you're going to see this little thing here. Thank you for choosing Treasury Direct. It takes just 3 steps to open an account, and it's like this. So when you click open an account, the first thing you want to know is you want to open an individual account. All right. Now, there are different kinds of accounts you can open. You can open a trust account. You can open an account for a business. There are many businesses and trusts and other entities that like to invest in government securities. You want to open an individual account. So you're going to click that. Now, the good news is that when you log on for the first time, it defaults to an individual account. So you're not going to have to worry about choosing that. Looks like we have a question that came up here. Melissa says, when I was researching out on my own, I located a historical table or rates. I did not understand it. Is there a way to see what the average over the 5, 10, or 15 years? I'm trying to decide if I bonds or a non-variable annuity is a better option. I did find a place where they printed some historical rates, or what the rates will be, but I have not found anything, Melissa, that goes back that far. I'm not sure that, and if they do predict, I'll see if I can find that. And if I do, when I send out the recording of this, I'll include that as well. But I'm trying to decide if I bonds or a non-variable annuity. So you're looking at either a fixed or an indexed annuity, okay, versus I bonds. So here, let's talk about this for a second, because I've been also getting a big question of, now that interest rates are going up, should I look at CDs or share certificates at a credit union? That's what the CDs at a credit union are called, share certificates. Here's the thing. Interest rates are going up, but the interest rates on CDs have not quite caught up just yet. They're still somewhat lagging. I've been looking for CD rates for a while, and I'm still struggling to find anything that eclipses 3%. About the best I can find, and that's with like Citibank or something online, is 2.75. So a lot of CD rates are still quite low. Now, if you're looking at a non-variable annuity, or what we call a fixed or even a fixed index annuity, so those two types of annuities are annuities where you can never lose money due to market fluctuations. You're never going to see the value of your account come down. A variable annuity is an investment directly in the stock market and therefore can lose value. And that's what Melissa's talking about. She doesn't want to lose money. That's what I'm assuming based on what you're saying, Melissa. And actually, we are seeing that even short-term fixed annuities, like 3 years, okay? So if you're going to go out and buy, if you've got some cash sitting on the sideline, you want it safe, you want it somewhat liquid. If you're going to put money aside for some special project, but you want to earn a little bit more interest, you're still not going to quite get there with CDs. Now, what's the plus side with a CD? If you're buying a short term, like a 6 month or a 1 year, you can get your money out pretty quickly. With an annuity, once you put that money in there, it largely is illiquid until that term is up. So there are trade-offs, right? However, even with some 3-year fixed annuities where the interest rate is fixed for the entirety of the 3 years, some of those rates are approaching 4%. Now, an I bond right now is absolutely destroying that. But keep in mind, the I bonds interest rate is tied directly to the consumer price index, inflation. And when inflation begins to come down, and it will come down eventually, then so too will the interest rate on your I bond. So it becomes a question of what's most valuable to you. Do you want consistent, predictable returns over X amount of years, no matter what? Or do you want to treat this as more of a, well, I'm going to get it while the getting's good, and then when the rates go down in my I bond, I'll simply cash them in and do something else with my money? That's the question that you have to ask yourself. You also have to ask yourself, Melissa, how liquid do I need this money? How much access do I want for this money? If you buy I bonds, you have to hold the bonds for at least 1 year. And then after that, you can sell them if that's what you want to do. With the annuity, you're going to have to keep it in there for 3, 5, maybe up to 10 years. 10 years is the maximum length of time for a fixed or an indexed annuity in the state of Oklahoma. Other states, 14 years is the max. The point is, with an annuity, you're probably going to get a better interest rate right now, even with a fixed, but you're also going to have to keep that money in there for a longer period of time. So what's most important? more consistent interest over time, or access to my money sooner. And therein lies how you're going to decide which way to go. Okay. Nothing is perfect. There are always trade-offs, but that's a great question, Melissa. You're very welcome. She says, thank you. You're welcome. Okay. So once you go online and you open up this account, let me come back here. All right. So the three-step process, you're going to get your information, and you want the application type. So you want an individual account, and the application type is a Treasury Direct account, because that's what you're setting up here. All right. All right, here we go. And as I said, the individual account is the default option. So you don't really have to worry about checking that, but make sure that it is, but it's going to default to individual when you first log in. Step number 3, it's going to guide you through this process. You're going to take that information that you have from step 1, your social security number, your name, your address, bank account information, all that, and you're going to enter it in here. Just follow the prompts. It couldn't be simpler. I walked my mother-in-law through this exact process on the phone one night, sitting at my dining room table. And by her own admission, she's not the most technologically savvy person. She figured it out. It's pretty simple. All right. So you're going to enter in your personal information. Step number 4, you're going to select a personalized image. So obviously this is an online account. Privacy, security, very important. So you're going to select an image and a caption that you will remember. And think of this like a visual password, so that anytime you log into your account, if you don't see that image on your account that you set up, you'll know one of 2 things is true. You're not logged into the right account, or someone else logged into your account and changed that. And that way you'll know. All right. So this is like a digital visual password that you set up for your account. Step number 5, now you're really going to secure your account. So you want to select a password, a username and a password for your account. You're going to have to set some security questions, and it's always a good idea. And I know you've done this before. What is your mother's maiden name? In what city were you born? And what was the name of the first pet that you had whenever you lived, blah, 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 whatever. They should be answers that nobody else can guess, but that are easy for you to remember. Click submit and move on to the next screen. Finally, and you're going to have to put your email address in there too. So once you've done this and you submit all this, you should receive in your email pretty quickly a confirmation that you've set up your account. It's going to show you your account number, and it's going to give you login instructions. And more than likely, there's going to be a button right there to say, hey, log into your account. You're going to put your password or your username and password, and then you're going to log in. Now, once you get there, okay, that's when you're going to be able to go in and look for all these different securities that you have access to purchase. And there aren't just I bonds. There are Series H bonds, there are EE bonds, there are different kinds of government bonds that you can purchase. So you're just going to look for buy I bonds. I mean, it's all right there. It's pretty easy to find. But here's what you need to know. You can purchase, there's a limit to how many I bonds, dollar amount, that you can purchase in a given year. You can purchase up to $15,000 in I bonds each year. 10,000 of that can be held electronically inside your Treasury Direct account. You can actually buy paper bonds that they will mail to you. You can buy $5,000 per year in paper bonds, but the only way that you can purchase those is when you file your tax return. And if you get a refund from the federal government, you can use that refund to purchase up to $5,000 in paper bonds. Most people just buy the $10,000 and move on, because that's what you can access directly through Treasury Direct, and you cannot purchase them any other way. Treasury Direct is the only way to do it. The good news is it does not cost you one dime to set up a Treasury Direct account. I set one up. I haven't bought any I bonds. They don't really fit within my risk tolerance. You know, people have said, well, Damon, have you bought any I bonds? No. Well, why not? Because my risk tolerance and my goals, what I'm trying to accomplish with my money, does not involve safe bonds at this point in my life. I'm 45 years old. All right. So my risk tolerance is quite a bit higher than someone who's 65 or 70. So this all depends upon what you're trying to accomplish. All right. Now, when you purchase the bonds, as I said earlier, you must own them for at least 1 year. Okay. You have to hold on to them for at least 1 year. Past that point, you can sell them at any time you want, but just understand that if you sell them prior to owning them for at least 5 years, you will sacrifice or surrender 3 months of interest payments. May not be that big of a deal, but just know that there is a cost if you sacrifice or surrender those prior to 5 years. You also need to know these are variable rate bonds. They will change. Many of the bonds that you go out and buy inside your investment portfolio, whether it's in your 401k, your IRA, your TOD, your trust account, your individual brokerage account, whatever, you are buying typically corporate bonds. When you buy a corporate bond paying 5.25%, that interest rate is not going to change so long as you own that bond. The value of the bond may go up or down depending upon what interest rates are doing, but your rate is never going to change. That's why people like bonds. Number one, they tend to be less risky than stocks, and the income they generate is fairly dependable. An I bond is going to be different. The I bond, the face value is never going to change. It's whatever you bought it for, okay? But your interest rate is going to change every 6 months. And it's only going to be high interest when inflation is high. Most of you would probably say, Damon, I would really like for inflation to come down. We all do. Just know that if you buy I bonds, the interest rate of your I bonds is going to come down too. But the interest rate that they're paying is always going to be above inflation. So that's the thing. This is an inflation adjusted type of security. There's another type of security called TIPS, TIPS, Treasury Inflation Protected Securities. Those are also available on Treasury Direct. These are a type of government security that is designed to outpace inflation, whatever that rate may be. So if you're purchasing these bonds just to get the 9.62% interest, just know it ain't always going to be that way. But if you're purchasing them to outpace inflation for a segment of your money, it's going to accomplish that job for you, no problem. All right. So I've given you a crash course in what I bonds are. What questions does anybody have? Or has anybody bought I bonds and you'd like to share your experience with them? I'd love to hear, because as I said, I have not bought I bonds. I've got a few clients that have. And so far, they've been pretty happy with them. But I'd like to hear what you have to say. Or do you have any questions about anything else? Whether it's the economy, the market. Were you satisfied with the Thunder's draft picks last week? You know, I mean, whatever you want to talk about. Okay, we do have a question here. Is there a mutual fund for I bonds? As far as I know, not right now, Lynn. This is from Lynn. There's not a mutual fund for I bonds because these are federal government bonds. And so the only way you can get them is through Treasury Direct. So as far as I know, there are no outside mutual funds that you can access I bonds through, because they're only available through Treasury Direct through the federal government. But that's a great question. I like what you're thinking. I like that. Eddie says, I bought some I bonds in April. So far, so good. Nothing exciting. That's what you want, right, Eddie? That's what, when investing is exciting to you, that's when you know there's probably a problem. Good investing should be damn boring, if you ask me. It should be boring. You want predictability. You want consistency over time. All right? Investing doesn't have to be, and really shouldn't be for most of us, that exciting. Day trading can be exciting, and it can also cause you to jump out the 5th floor window of your building. Right? So I really like boring, old-fashioned investing where I'm not really worrying about it too much, and you're not going to worry too much about these I bonds. Really good comment. Thank you, Eddie, for that, and thank you, Lynn, for your question. Does anybody else have any questions? Any other comments? Anything that you have on your mind? Anything that you want to talk about? I will share with you that we've been sitting in on a lot of webinars about the state of the market, that sort of thing. So here at ChappelWood Financial, we continue to keep ourselves up to date on everything that's going on. I'm listening to a lot of different economists and strategists right now. And right now, our base case is still about the same. We don't expect a recession this year, but again, that expectation can change if market conditions change. Right now, economic conditions are still about the same. Consumer demand is still very strong. Unemployment is still very low. Inflation is still very high. Those are not the characteristics of an economy in recession. Those are the characteristics of an economy in expansion. Now, we do expect things to contract, to recede a little bit. And I'm going to tell you right now, I'm going to prepare you right now. All right. It is June 28th today, or 28th. All right. Which means that the second quarter of the year ends in 2 days. Now, towards the end of July, we're going to hear the economic report, the GDP report for the United States. I'm going to tell you right now, it's possible that we will see the exact same thing that we saw in the first quarter, that GDP was negative. All right. GDP was negative in the first quarter, not because our economy shrank, but because our economy could not keep up with high consumer demand, and therefore we had to import more. Imports from other countries are a knock against our domestic production. As a result, it made it look like our economic output was negative for the first quarter. If that happens again in the second quarter, I can guarantee you that when you watch the news, they're going to report, well, we've had 2 consecutive quarters of negative economic growth. That's a recession. No, it is not. That is the media's definition of a recession. That is not what the Federal Reserve Bank in Atlanta, who's the one that is doing this, that is not what they're looking at. They're looking at actual economic output in the United States. And that output is through the roof right now. Well, not compared to last year, but it is much higher than what it typically is. So I want to prepare you ahead of time. You're probably going to hear that. Okay. I just want to prepare you ahead of time. All right. Here's another question. Let's see here. Will you be putting the last Capital Group seminar online? I missed it. So yes, last week there was a seminar or a webinar that one of our top high net worth strategists, Clark Capital, hosted. And it was for clients. And some of you probably logged on to that. You got logged on, or maybe you registered and you weren't able to get there. We actually have the link to that recording, and I believe Shelly, if you haven't received it yet, Shelly has sent that out to all of our clients. I will ask her again today to send that out. But I tell you what I'm going to do. I have the link, so I'm going to email it to every single one of you, everyone who is registered for my Wednesday drive-through, whether you're a client or not. I'm going to get that to you. It is approved for clients, and some really great information there to give you some real insight, a dose of reality and perspective on what's happening in the market and the economy. So yes, I'll get that out to you. Thank you for asking. All right. You're very welcome. Okay, it is 1 o'clock. So I want to be respectful of your time. I hope you enjoyed today's conversation on I-bonds. One more time, I'm going to remind you, never invest your money in something you don't understand. So take some time, educate yourself first. If you know a friend or a family who's purchased I-bonds, talk to them. Okay, they're going to know a lot more than I do. Like I said, I don't own any I-bonds. So talk to someone who has been there. Let's see what we have. Have a great 4th. Yes, it is 4th of July weekend. And so stay safe, everybody. It's the birthday of our nation. And, you know, no matter the divisions and the anxiety that we feel in this country, at the end of the day, we are all Americans. Well, unless some of you are immigrants into the United States from another country. But the point is, most of us, we're all Americans, whatever our beliefs might be. And I like to believe that on days like Independence Day and Memorial Day and Veterans Day and all of those other patriotic holidays, that we take some time to really feel and understand how privileged and blessed we are to live in such a wonderful country. Okay, we have problems like everybody, but we live in a really wonderful country. I wouldn't want to live anywhere else, and I'm guessing you wouldn't want to either. So thank you for following along for the first half of 2022. Second half of the year, maybe be some fireworks, we'll see. But stay safe, stay strong, stay educated, and we'll see you next time on the Wednesday Lunchtime Drive Through. Bye-bye.